Okay, so welcome to this month's Fireside chat, Chris. Thanks for joining us.
Thanks, Rob. Thanks for having me.
So we're without Clint this week. He's off on the high seas celebrating a mate's 50th. So I'm sure he's enjoying himself. Um, Speaking of enjoying themselves, there's not too much enjoyment going on over in the Strait of Hormuz at the moment. How? What's your thoughts on where we're at with regarding the war and what's going on over there?
Yeah, Rob, it's been interesting last 24 to 48 hours, I guess, in terms of what's come out. I mean, there's a bit of news released over the weekend with regard to us being closer to a deal, and it sort of came off the back of a whole lot of nothing, to be honest, because I mean, the week leading into the weekend was we're a long way away from a deal. So as it tends to be the case these days, we tend to be a long way away, then almost certain deal, and then back to being a long way away again. So back on one of those merry-go-rounds, and so the most recent one that we've had over the weekend is that President Trump's obviously put out some specific wording around the fact that they're close to a deal, but nothing's been decided or signed just yet. Iran effectively confirmed that to be the case as well. So previously, when one side would put out an announcement, the other side would scutter that announcement, but this seemed to be some confirmation of that. I think markets obviously liked the fact that one side confirmed with the other, both at pains to mention that they're a long way away from signing any deal. But it looks like in terms of that 12 or 14 point plan that was previously released, it looks like they're making some inroads on those points. And specifically with relation to the most recent one is that if they were to come to a deal, they'd separate the negotiation or the arrangement into two parts. So one being the reopening of the Strait of Hormuz, as you mentioned, and the second part in relation to what they do with Iran's nuclear facilities, and that seems to be a largely problematic point. So if you're smart, and I mean Iran has been pretty smart, they've linked nuclear capabilities to the Strait reopening, so that makes it very hard to negotiate anything. But it looks like they've reached some sort of negotiation where they could separate those 2 points out. So I mean, if the Strait were opened, that would provide some instant relief from a sentiment perspective. But it's fair to say that sort of supply chain shock would take at least 6 to 9 months to rectify, possibly longer, depending on given how long it's been shut for. So a bit of a sentiment spike, but I mean, from a macro and inflation perspective, it would take some time to settle. And then the broader deal, obviously, that puts an end to maybe some of the fighting. But in saying that, though, like they sort of agreed to that over the weekend, and come Monday, the US is bombing new targets again. So who knows? But that's what markets are trading off, I guess, early this week in terms of some of that news flow.
Yeah, yeah. Look, as you rightfully say, it's on again, off again. It's just been the way that things have been going with regards to deal or no deal. Sounds like a reality TV show, doesn't it?
Tons.
Um, but basically, from what I understand, if this Strait of Hormuz stays shut for too much longer, there's going to be massive ramifications, and the market's not pricing any of that in.
No. And
Um,
the other thing to add
so
there, Rob, would be that I mean they did I mean, for what it's worth, I mean the global politicians and it's obviously energy sort of OPEC and the like, they did release a lot of oil and gas when the war started, for what it's worth. So they sort of got together and bound
mm,
together and sort of released a lot. And that did actually help soften the blow a little bit. And I don't think it's been taken into account. That release is largely coming to an end in terms of its
great.
time. So unless there's
Yeah,
another large release, it's fair to say that even though oil prices have spiked, they would be significantly higher absent that release. And so without another release or an end to the war, it's fair to say oil and gas could rocket significantly higher from here. So there's a bit of an artificial price on it, and it has been for the last sort of 4 to 6 weeks, 4 to 8 weeks. And there's definitely a real risk which I think why both sides are sort of aggressively trying to negotiate this, because they understand the ramifications of where oil could trend in the absence of another release from OPEC and the like.
yeah. No, I agree entirely. Interestingly, the strategic reserve numbers. I was actually just looking at them last night. China obviously dwarfs everyone else, which makes you think. Um, but yeah, you're exactly right. The ability, particularly for the US, because they ran it down with Biden, and they might have put some more back in, but they definitely didn't top it up. That's for sure.
But
So, yeah, at some point, yeah, the rubber's going to hit the road, because you physically need physical.
yep. Yep.
Yeah. So
It's physical. It's actually just regular flow. Like, you
Yeah.
actually don't need large amounts. It's just that the lack of regular flow is what causes significant issues. Even if it's small flow, there needs to be constant flow, and that's the one that we're coming to a head now, where in the absence of some sort of change or release, or like I said, enter the war, and we're gonna hit a stiff point in the next few weeks in relation to this. So
Yeah.
yeah.
No, agree. Now, Scott Bessent, when he took the job, he said, "Don't judge me by anything other than the US 10-year bond market rate." Well, Scotty boy, you're not doing
Fail.
too good.
Fail at the moment. So, yep, he did, Rob, as you mentioned. He did have he put a few pronouncements out saying that he should be judged based on metrics, not anything else, which is refreshing to hear, I guess, from a not an elected official but an appointed official, I guess. And you've got US 10 years when all bond markets, but particularly US 10 and 30 years, price or reprice aggressively over the last a couple of weeks leading into the weekend that I just mentioned. And so US 10 years had been hovering around the 430, 440 mark, and sort of spiked around the 450 mark. But in the last couple of weeks, that all broke, and they sort of broke through to the 470, 480 mark, 30-year above 5 for the first time in a long time, psychological barrier. And that goes completely against the statement you just made around Vescent, sort of what we're supposed to sort of charge him with regards to his success. That presents a real significant problem for US deficits and debt load in terms of their ability to refinance from here, and the cost of that just goes up. So they will, like I said, again, that might have helped provide some impetus to the negotiations over the weekend, because if the bond market tells you they're not happy, as a president or as a treasury secretary, you've got no choice but to listen.
Yeah.
So you want people to keep buying your bonds. You've got to make some adjustments. And bond markets, I mean, it's a very large market, as we know, and it can be very aggressive at times. And that's the last thing you want is paying 5% plus on your debt you have to roll over. So interesting repricing. It did reprice all global sovereign bond yield curves. So there was some correlation and upward pressure on all of them. Australia is already obviously higher off the back of the RBA's action, but it did push up other bond yield curves around the world in terms of the BCB, Bank of England, and the Japanese bond curve as well.
Now, just on that, Chris, the latter two, they are the largest US Treasury holders, right? So pressure at home could see them selling US Treasuries, which would make this whole thing worse.
Yes, I mean the Japanese are in a world of pain at the moment with their currency, as some may know, with the yen at ridiculous levels, and so they've intervened once. They don't really want to intervene again, and the more they intervene, the more capital they use up in doing so. So it's not like the buyers of US Treasuries, like you said, are in a healthy place. They're in a strained
No,
place themselves. They have to
that's
focus
right.
on solving domestic issues, and so buying US Treasuries is not a primary focus of them right now, from a support perspective. So yes, that doesn't bode well for US Treasury Secretary Bessent either.
No. Now, the AI trade, it's back. It's
It is.
roaring.
Yes, it's roaring. It's an incredible beast to follow and watch from afar or up close, depending on how much of it you own. But it's been a crazy few weeks in terms of the rally we've seen in tech, off the back of that was the precursor to the weekend's announcement that we might be getting close to a negotiation, which, I mean, at this point seems to be a furphy in terms at the time it was. But the market took the negotiation plans as a positive, and off the back of US reporting season, where the AI tech stocks did report well, for what it's worth at the surface level, markets took that as a sign to rotate and rally hard into equities. And so what equity investors are doing now is, given the uncertainty related to the war and the first, second, and third order impacts of oil supply shock, energy shock, and inflation, they're just trading the part of the market very simply that is the furthest away from oil and the Middle East, and that happens to be tech. So another rally in tech AI stocks. I mean, a bit of it supported by some positive momentum out of in earnings season in terms of the timing, but a lot of it just people putting money to work in the furthest or most removed part of Iran effects, without any sort of understanding of fundamentals or valuations or risks or anything like that. So it does set us up for another bubble, if you like, in that part of the market, if we didn't already have one. But I mean, I think there's some comfort there from investors given the capex cycle for AI is largely known for the next 12 months with a fair degree of certainty. Beyond that, it's throwing darts. But for the next 12 months, we largely know what these hyperscalers are going to spend. So you can work backwards from that to work out what the investment case is. So back to good old tricks for investors of applying money into one part of the market, effectively 5 or 6 stocks in the US and 2 or 3 in Asia EM. And that's what's sort of rallied hard. So if you're looking through portfolios or what you own, if you hadn't owned those stocks in large quantities or managers hadn't owned those stocks in large quantities in the last sort of 4 to 6 weeks, sort of fell a long way behind the index moves that we've seen. So concerning in that we want breadth and depth in equity market winners for that rally to be sustainable. And in the absence of that, it takes us back to concerns we had last year with that one-dimensional trade pattern reappearing again.
Yeah, no, I agree. Now, the thing I find interesting about the AI space is like, a couple of years ago or a few years ago, it was all done from cash flow, all this capital expenditure. Now it's on the tick. It's debt.
It is.
So um, you got we just spoke about bond rates going up. There's demand. There's if you're issuing more debt, there's more demand. There's got to be more supply of debt per se. There's got to be more demand. Where's all this coming from? Higher rates. And the good thing about, well, not the good thing, but the thing about debt is that you got to pay your interest bill.
That's
So
it.
all of a sudden, the narrative of we're going to make heaps of dough in the fullness of time probably doesn't wash when you've got interest repayments that need to be due and met.
Yeah.
So depending on how they're going for actual real cash flow, um, it could get interesting very quickly if what the market thinks isn't matched by the reality.
Yeah.
Um,
And the other thing to note, Rob, I think we've mentioned before as well, is that, I mean, these businesses, I mean, for a long time purported themselves and sold themselves as being capital light models.
yeah,
And so, I mean, you can attach, I mean, there's a frame of thinking around attaching higher multiples to capital light models, particularly with strong growth momentum behind them. But once they shift to more mature business models and with heavy capital intensity, not just debt, but other capital intensity, it's very hard to assign the same lofty multiples to those sort of businesses. And so AI and tech are no different to any other sector where if they're capital heavy, and the multiple has to be lower than it has been in the past. And that definitely hasn't happened yet. But again, if you combine that with, like you mentioned, the having to raise money from elsewhere as a combination, there is some risk rising in regard to the exuberance attached to some of these names.
yeah. Just inside the special situation strategy, we've got some exposure to Asia tech. So we predominantly liked, well, there was really two narratives around that. The first being that, China's, it's a big player in this tech space, even though the market seems to think that, the Americans, the end all and the be all, and they're going to win. That may or may not happen. But I guess the other thing from that side of things is initially when we got interested in that space, the valuations of China tech was just nothing compared to the US tech. What are you seeing in regards to, I guess, the global valuations? Is China starting to claw back some of that gap that was, say, present, 18 months ago, 2 years ago?
It did through the course of last year, Rob. So Chinese equities had a really good 2025. And like a lot of that was supported by some of the tech AI names that you sort of mentioned in terms of the Asia tech exposure. But it's fair to say some other Chinese equity names did well last year as well. I mean, sadly, coming back to the comment I made earlier, a lot of the winners in China, Asia more recently have been AI tech names again. So it has narrowed again, even in the Chinese and Asian equity markets. But we did see some broadening out of winners through the course of 2025. Worth noting that, I mean, as we all know, given we're a resource-rich country, there's a lot of resources that need to go into these sort of things. And China is resource-rich in some respect as well, in terms of some of the resources they have that they can use into AI, semiconductors, and the like. So there's a broader trade in relation to Asia, China than just AI or hyperscalers. There actually is a broader trade there. What I would say with regards to Asia tech is, and you mentioned sort of the US winning the AI race. I mean, there's no way China lets US win it easily or hands down. I think there'll be two winners of AI race, and that'll be both China and the US. And so I think they both win effectively. And so you need to be playing both AI tech winners if you are serious about playing that part of the market. Just playing it narrowly with the US name doesn't make a whole lot of sense, because there's no way that China's going to let the US sort of win that hands down. So you think about the Asian tech names, like you've got TSMC, you've got Samsung as well, and a range of other inputs to AI and data centers and the rest, and they're incredibly strong, healthy companies. So yeah, so that position in the portfolio, as you mentioned, still playing out well.
Yeah. Well, I guess we'd be remiss if we didn't discuss Dr. Jim's budget and the uproar that it's caused. Um, so I guess what were the main changes that were announced in the budget?
Yeah. So look, leading into the budget, I think, I mean, it's fair to say when the RBA is raising rates, they are firing a shot across the bow that you need to do
Yeah.
something on the policy side. And so, I mean, the government spent the better part of the last 2 years not listening to the RBA. And it's fair to say the RBA's had enough with some of the recent speeches and comments we've had.
Yeah.
So, fair to say the government got a warning leading into the budget that they needed to try and balance the budget as best as possible. And that meant capping some of the, I mean, areas of like significant growth expenses. So NDIS being one, and a few other areas. So not necessarily scaling them back, but just sort of retrofitting the models attached to those to try and scale back how much the expense line is growing there. And then obviously having to find savings elsewhere. And when the government says savings, I mean, that largely means increased taxes to you and I. It's a nice marketing motto they put on it. But effectively, they had to find savings from elsewhere because they can't drastically cut expenses too quickly, given cost of living pressures largely dictate elections these days. And so they found it upon themselves to go after investors, and not just one area, but multiple areas. So effectively, CGT. They've gone after. They've also gone after what's been purported as a death tax, so relation to discretionary trusts and the like. A bit of truth behind that, and some scaremongering around that as well. And then also in relation to negative gearing. So some pretty significant impacts. I mean, they're largely been things that most government watchers have told governments to stay away from for many years, for risk of getting voted out. But it's fair to say, given in combination of things, I mean, Labor needed cost of living relief, it needed to find savings. It's got an unassailable lead federally in terms of how much they won the last election by. So I'm not surprised that they went after investor taxes. But it's fair to say, I mean, it's a dog's breakfast at the moment in terms of trying to figure out the implications, the second and third order implications. Does it drive money offshore? Do people start pulling money out of houses? I mean, after 3 RBA rate rises and maybe 2 on the way. So just the ramifications of it and the uncertainty attached to it are fairly aggressive. And it's fair to say it's still in a state of flux in terms of their ability to get this through. I mean, they've largely got the numbers to get it through. But it's fair to say, I mean, as it stands right now, I'd be very surprised if they got it through in its original sort of format. But we'll wait and see. So it's going to be a ramification for market. I mean, probably the best case in point was the day after the budget, CBA stock fell 10%. So for what it's worth. So, I mean, that's the biggest one-day fall in CBA's history, 10% in one day. And that's a pretty good market reaction to not liking what the government did put out in that budget.
Yeah. Well, to be fair, CBA is not a cheap stock either.
So it's not.
Yeah, so I think the view that we've got internally is just that just sit tight, see what happens. Don't go running around trying to solve problems, assuming this is going to get through, because I think the political backlash is going to be wide. And at the end of the day, you're right. He's got a big majority, but he did only get a third of the primary vote, and I think the dynamics of Australian elections have changed. You know, 10, 20 years ago, it was the big two parties, and if you held 90 seats, mate, you're good for the next 3 terms. I don't think that's I think that's too simplistic these days. And if particularly the right get their preferences sorted, he could see that turn around very, very quickly. And if I was a Labor backbencher sitting with a 2 or 3% margin, I'd be very concerned that I wouldn't have a job if they sort of try to push these forward as proposed.
Agree, bro.
So we'll see what happens.
Yes.
Um,
pretty significant changes to slap in one budget for what it's worth. So,
Yeah.
but yeah, I mean, look, I think, look, all of us have been talking about reform for some time. I mean, you can take reform at different angles, different paces. I mean, there could have been significant other areas you could have attacked from a reform perspective, but they went after investor taxes as the first point of call. So,
Well, you can't have Australian tax reform without including the GST.
yes,
Yeah.
100%.
So it's just a nonsense.
Yep.
All right, mate. Thank you very much for making the time. I understand you're in
Nice.
sunny Cairns,
I
so
am.
we'll let you get back to the pool and enjoy the rest of your day.
Thanks, Rob. Appreciate it.